Innovation needs to be something that is embraced and pushed for from the board and C-suite of a bank or credit union. I mean, and if it's not being driven from the highest levels of the organization, it's never going to get prioritized, and there'll be no support for that type of innovation.
The Digital Banking Podcast is powered by Typhon. Typhon is the creator of Infinia, a dramatically better digital banking platform for community financial institutions, as well as several platform-agnostic, revenue-generating point solutions. Our highly configurable platform and broad ecosystem of third-party partners ensure our entire suite is scalable and extensible to meet the needs of any FI. On our podcast, you will hear host Josh DeTar discuss today's most pressing financial technology topics with seasoned industry experts from every possible discipline.
You know, your podcast hasn't officially made it until there's ads in it. But this is one you're not going to want to skip past. And, well, if you do, feel free to hit that fast forward 15 seconds button twice. Ever wonder what gives me my energy and enthusiasm during these podcasts? You know, outside of my relentless desire to learn about, connect, share, and build up community FIs and their mission to support the communities they serve? It's coffee, and lots of it. Now, you want to know what's better than your regular old coffee? How about donating $5 to the Children's Miracle Network hospitals through Credit Unions for Kids every time you purchase high-quality, ethically sourced coffee that also provides living wages to coffee farmers? So if you want to listen to this episode with epic levels of caffeine-induced focus and help kids in need, head to javaforkids.org to learn more and buy a bag or 10. Thanks.
Welcome to another episode of the Digital Banking Podcast. My guest today is Brian Kaas, President and Managing Director at TruStage Ventures. This is going to be a really fun episode. If you're listening to this podcast and you work for a community financial institution or a FinTech that serves them, you may have wondered what it looks like to see how the sausage is made. Brian says he gets asked that question a lot when it comes to how do FinTechs get born and how do they raise funds to scale. He said he always has a good chuckle because he actually worked at a food processing plant in his younger years making sausage. So he has literally seen how the sausage is made. Brian is a true Midwesterner. Born and raised in Wisconsin from humble roots, he was the first in his family to go to college. And when he did, he even stayed in Wisconsin. But he didn't just go to college to check mark a box. He went big, and he went to law school to become a lawyer. Cool note to the story. His best friend in high school and he made a pact to go to law school together, and they actually did. I quickly gathered in my first meeting with Brian that he's a genuine and transparent person and is excited to share some of the behind the scenes of the sausage making of investing in fintechs. Brian believes in the work that community financial institutions do to bring financial health and freedom to everyday Americans. As TruStage watched the rise of fintechs going direct to consumer, they saw the threat this posed to the relevance and viability of those community FIs and the work they do to support specifically the middle market. So in 2016, a venture was spun up that Brian has an opportunity to lead in looking for fintech companies to invest in that provide technology to help community FIs continue doing the amazing things they do. Brian says one of the things he loves so much about his role he plays is being able to see the spirit, passion, and sweat entrepreneurs put in to start something. He gets to hear their dreams and help find avenues to bring their great ideas to the community FI space. Linking back to his Midwesterner roots, seeing the sweat equity people put in is invigorating to him. Brian loves to spend the weekends with his family on the lake, chilling, relaxing, grilling, just maybe not sausages. We have a whole host of topics to cover today to understand the role of capital and networking in bringing great tech to the industry we believe in so much. So, Brian, without further ado, I'm super excited to welcome you to the show. Thanks for being a guest.
Thanks, Josh. I'm super excited to be here with you today.
Kind of going through the intro, I think people get an idea of probably where we're headed with this thing. But in all seriousness, I'm super excited to talk to you because I was at FinTech Meetup, not this most recent one, but last year. And I thought it was really fascinating I'm sitting there in the crowd and I'm sitting next to a couple of credit union folks. And one of the first speakers is representing a VC firm investing in fintechs and goes off on this spiel talking about how they deploy capital and the things that they look at. And to be honest, when he was giving the talk, it was a pretty bleak one. It was a pretty bad outlook. And I'm just watching the shock and awe on the faces of some of the people around me going, oh my gosh, like I've never seen how the sausage is made, and understanding, what this means to some of the companies that we actually rely on for some of the technology that we receive. And so I found that just interaction very interesting. So I'm really excited to have you on as a guest to kind of peel back some of the layers and just talk to us a little bit about from what you see in your seat in day to day. So, before we get too far in, I'd love for you just to kind of expand a little on TruStage Ventures and kind of what you guys do in the market.
Yeah, just kind of in a nutshell, we're a corporate venture capital fund that focuses on investing in fintech companies that are looking to partner with and work with community financial institutions. Our parent company is TruStage, which is a large insurance and financial services company that serves almost all credit unions in the U.S. market. And recently we acquired a technology company that works with about 1,800 community banks. So we really want to leverage sort of the network and relationships that we've built over the 90 years of our parent company's history to help kind of bridge the gap between fintech companies and credit unions and community banks. And we see those worlds, being very different. And a lot of times, I think to your point, to your experience at FinTech Meetup, we see that, day in and day out. And so how do we, kind of bring these two very different worlds together through TruStage Ventures? So it's much more than just investing. Really our mission is to kind of bring those worlds together and help drive innovation for the industry.
That also gives you kind of an interesting look at the industry, right? Because you get to see so many different companies that are popping up. And I would argue it probably even puts you a little further ahead in the curve of seeing what's the next top trends, what's going to be the next buzzword, right? Because you're seeing companies at their infancy a lot of times coming to you looking for capital to scale. And so you're kind of seeing, oh, hey, look at this. All of a sudden, we've got a bunch of pitch decks with companies that are .ai. I have a feeling AI is about to become the next hot topic, right? So I don't know. What has that been like for you to kind of see the early onset of some of the next trends and where you're seeing companies try and head to?
It's been really interesting. I think if we were to go back 18 months, obviously AI was around 18 months ago, but really hadn't taken off the way it has now. I would say, because there are close to 10,000 fintech companies in North America, every idea that could possibly be, thought of is now morphed into a company. And so seeing fresh ideas became, less frequent, like I said, 18 to 20 months ago. I think with the introduction of AI and all of these new use cases, it really is, I think, breathing new life into the fintech space. I think there's going to be a next wave of innovation that we see, really complement a lot of the technology that's been, really kind of rolled out and developed over the last decade. And I think it's going to kind of drive this resurgence. And I think from the lens of community FIs, it will put even greater pressure on those traditional financial institutions to innovate, really kind of drive some of these technologies into their organizations to stay, efficient, relevant, and viable.
You made a really interesting comment in there, though, that for folks who probably, listened to some past episodes have probably heard me touch on before is, I think AI is a great example of this and probably one of my most obvious examples of this. But I think a lot of times and I generalize but we look at whatever the next big thing is and we want to apply it. But you have to understand, what does it actually mean? How are you trying to apply it? Because a lot of times it's just a tool and you need a use case for a tool. And I think AI has been a really overused term in that sense. And, we hear a lot of people, the example I've given on the podcast in the past is, we want to have an AI strategy at our credit union. I'm like, great. That means a lot of things. So what does that mean to you, right? Like, what are you talking about? What is the use case you're trying to solve for in that? So I'm just curious, like, how have you seen that on your side of, are you seeing a bunch of companies come to you and their pitch deck being like AI, and you're like, okay, well, yeah, I mean, I know that's a buzzword right now, and you probably think we want to hear that in your pitch deck, but like, what is your use case for that? Like, what have you seen? I'm just curious.
Yeah, I'd probably go the opposite direction of I look at what are some of the challenges that the customers of those AI focused fintech companies are trying to solve, and is there a market for that? So to find out if there's a market, you have to really go and listen to the executives of credit unions and banks and what's top of mind for them. And then can AI be used to help solve some of those challenges? So for example, what I'm hearing right now in particular, fraud is a huge issue that's on the rise within the financial institution space. Profitability is also a huge challenge that's driven in part by just much lower return on assets. So I think banks and credit unions will face greater pressures of how do we bring more automation into our organizations? How do we drive more efficiency? I think also, looking at lending performance, for example, and how do we get better at our underwriting to reduce delinquencies? Maybe how do we, try to improve our underwriting to reach and serve a broader group of consumers? To me, those are all good use cases of where AI can be a tool to help achieve some of those like key strategic objectives. So that's kind of how I kind of back into, where AI can be powerful in helping to, really kind of accelerate some of these priorities, because I think AI in a vacuum, doesn't have a market or use case by itself that, when I wear my investor hat, creates a viable business that will survive.
Yeah. Yeah, we were talking about this before we were recording. It's like everybody wants to throw it on their name in there, what we do now, because, everybody's like, well, exactly that. We have to have a strategy around AI. We have to have AI. We have to implement AI. And I'm like, great. All right. If I put AI in my company, like, I keep joking. I'm like, one day we just need to change our company name from Typhone to Typhone.ai. Sales will double overnight. But, it's more than just using Chat GPT to write your pitch deck, right?
Absolutely. Right. That's so true. And I think, everyone thinks of AI as, it's kind of Chat GPT and how can we use that? And again, that's a use case, but I mean, there's so many other variations of how artificial intelligence is getting, incorporated into a lot of these real world practices. And, I think even maybe taking a step back from that, it's again, I think puts a very acute pinpoint on the need for banks and credit unions to really kind of embrace the changes in technology, because the AI is only going to accelerate the pace of change that we've seen over the last decade. And so if you're not really keenly focused on what all of these changes are going to have on your credit union or bank, it's really going to catch you flat-footed. And so to me, that kind of just frightens me more, because I just see things changing that much faster, which I thought wouldn't be possible from what we saw over the last decade.
Yeah. Okay. I'm curious. I'd like to pick your brain on that one. So, talk about kind of the change in pace that you've seen over the last decade, and like, how has that influenced, your investor hat and looking at different organizations that you all are looking to invest in that you believe will fundamentally bring, obviously, both returns to the fund, but also returns to the industry that you're trying to serve in terms of great technology. Like, how has that changed over the last decade?
I think, obviously the word digital has been around for, again, a decade. Everyone's trying to do more and more digital. But I think with sort of the more widespread adoption of usage, it's going to create even greater expectations for consumers to have these frictionless experiences, hyper personalized loan offers or other offers. And it's just going to, I think, further drive consumer expectations and make it easier for those consumers to switch to some other financial provider that kind of provides, this truly automated, seamless experience that's, amazing. And so if you're a bank or credit union that has, clunky experiences, you're just going to see so many of those members move to these other companies, and trying to keep up with the pace of where the change is going to become more and more difficult. And that's, where I really tell those FIs, partnering with fintechs is really the only way you're going to have any chance of keeping up with what Chase or Citi or any of the big banks are doing. Point out for the tech budget of JP Morgan Chase is almost twice the size of the credit union industry combined. And so we're not going to outbuild what the Chases are doing. These fintech partnerships are really the pathway to long-term viability, and kind of the sooner credit unions and banks kind of develop that muscle of how do I work with a fintech company and how do I make this successful. And there might be some failures along the way where the partnerships don't work out as intended, but that doesn't mean you can't stop. Innovation often is ugly. It is going back to seeing that sausage being made. It's not like you have perfection out of the gate, but you got to keep trying. You have to keep iterating, and it's just really going to be critical because these community banks and credit unions serve a very vital role in providing financial services to rural areas, to middle and lower market consumers. And so I really want to ensure that those institutions survive, and we have a really strong and competitive banking system in the U.S. a decade from now.
You made a comment that I really want to talk about, because I don't know. I don't want to say that this doesn't necessarily get talked about a ton, but I don't feel like it does, at least in my circles, right? When I'm talking to folks at community financial institutions, and maybe the conversation is happening, just I want to talk about it pretty bluntly. Like you talked about just the ability to have access to capital to be able to accelerate the pace of technology. And you look at somebody like JP Morgan Chase and the amount of money that they spend. But even then, that's just on technology as a whole for JP Morgan Chase, right? That probably included in that technology budget was, buying everybody at corporate HQ new, computers. Right. And so, but you look at, just go do a Google search every once in a while and look and see how much capital, well, maybe not right now, but we can come back to that, is being deployed to fintechs, like true startup fintechs that are direct to consumer, right? And if you all of a sudden see ABC FinTech just raised $300 million to solve whatever, let's just pick a simple use case, right? Digital new account opening. They just raised $300 million to focus on one thing and do it better than anyone else. So, not to be mean, but I'm looking at all of us in our industry. Like, what credit union do you know has deployed $300 million to solve one very specific problem? None, right? And so that is a very difficult thing to be in a fight up against, right? Like, that is a total David and Goliath type of scenario. So you can't play the same fight. You have to think differently. And I think that was the point that you were alluding to is the way for a, $700 million asset under management credit union to be able to battle a fintech that just raised $300 million to do one thing very, very well is to partner with another fintech that just raised some money from you guys to go do something really, really well.
That can be, more accurate. I mean, that really is the point that I make. I think the days of a smaller FI being able to kind of build their own organic technology to serve their members. There might be, some examples here and there, but I think, those days are largely behind us because to your point, there is so much money and so much talent going to these fintech companies trying to focus on very narrow challenges, but to be the best that they can in that space. Credit union has to serve, account opening and lending and different loan classes. And, there's all of these services. You can't, have the best technology in any one area. And so the only path to really keep pace, again, is partnering with companies that are going to be able to not only develop that technology, but you also have to maintain it. It's like when you look at the costs of maintaining this technology, it's very expensive. And so I think in some organizations, kind of put a knock on anybody, but a lot of times CTOs and CIOs are like, hey, I want to build that. Like, why would we go and kind of outsource something that we could do internally? And, they have oftentimes a lot of influence on, the organization. And what I see happening is it's a project that takes, twice as long, 3 times more expensive, and then, doesn't maybe deliver the results that we had hoped for. And that's not just, that's in any industry with large, more mature organizations. We're just not always the best at, innovating and building cutting technology when that's not kind of the day job of our companies.
Yeah. I think that's like overtly true in this industry too, right? I mean, you think back, if you just put a, stake in the ground at 2000 and really before that, we were all starting to dabble in tech, but it was definitely not as pervasive as it is today. That was only 24 years ago. I'm terrible at math on the fly, but I saw some like Instagram post recently that was talking about like, the year 2300 is actually closer than, the 1980s or something like that. And you're like, oh crap. Yeah. Like we're actually we're not that far away from like where we were a while ago. Anyway, my point is that it wasn't that long ago that our industry did not have to deal with technology as a competitor at all. And it was just in the last couple of decades where we've had to go from like my only competition was, did Chase have a nicer branch in my town than I did and a bigger billboard, further out in town so people saw it before mine? Like that was kind of your competitive space. And now all of a sudden you're having to compete in a totally different arena, and not even just against the traditional players you were used to competing against. Now you've got Chime popping up and all of these different direct-to-consumer fintechs. And they're raising exorbitant amounts of capital to be really good at specific things and to scale aggressively because, as we know, right, when all of a sudden you get a huge influx of $300 million from VC, there's an expectation behind that. You got to scale that sucker. So that is the objective, is to do one thing really well, scale it very quickly, and take over the market. That is a very different competitor than traditional community financial institutions were used to having to fight against. So even then, like it's had to be a total cultural shift of we now have to start thinking like fintechs, even though our business is a very traditional business. And inside of our 4 walls and what we have to focus on is very different than trying to think like and act like a fintech.
I completely agree. Financial services and banking, largely stayed the same for hundreds of years, really up until like the last 25 years or so, where we suddenly saw, the introduction of all of these new technologies, all of these new entrants. I think the one group that you didn't mention that to me maybe causes the most angst is just some of the large retailers in non-traditional FIs starting to move more and more into providing different types of financial services and, embedded finance and embedded banking. Walmart has quietly amassed a large fintech team over there, and they're offering checking services to their 2 million employees and have at least provided some, indications that they would, like to roll that out to all Walmart customers. And they're offering an auto buying program. And I just heard that Amazon is quietly building out an automotive team where they want to sell cars on Amazon. So what does that mean for credit unions that, historically have had those local relationships with their dealers, and auto lending is, kind of the bread and butter of how they keep those branches open. And so it's, I mean, again, like just these radical shifts that are occurring in real time, you really, requires credit unions and banks to be, really more nimble and more open to thinking differently. And where I live, I mean, I still see a lot of branches going up everywhere. And, but those same credit unions and banks are not really kind of doing a lot when it comes to technology and these fintech partnerships. And I question, like, is that the right strategy to have in this day and age?
I had a guest on the podcast not too long ago, Danny Payne from Jack Henry, and he and I talked about the number of financial services apps that a person has on their phone. And he had done some research, like within just his own like friend group and outside of work, right? Not people in financial services, not people in fintech. And then we subsequently did it as a poll on our LinkedIns and everything. And the data lined up on both fronts, even when we asked people in our industry. But we asked people, like, how many apps do you have on your phone that are financial services apps? And I would say on average, people told us they had between 3 and 5. And then when we helped them understand how many of the apps that were on their phones actually were doing financial services, you know what the true answer was? It was north of 20 for the average person, right? So to your exact point, like I don't think a lot of people actually see just how much is starting to eke into financial services from exactly that, from big tech, from big retail. So yeah, to your point, I mean, just the swath of competition is significantly larger than it was even just 25 years ago. And that landscape looks totally different.
Right. I mean, consumers have so many options to pick from today in terms of where they're going to deposit their funds or invest funds or obtain financing. And they make it so easy to, get financing at the point of sale. And if the credit union or bank isn't like embedded in that technology, those are loans or deposits that credit union will never get an opportunity to have on their balance sheet. And one of the things that we focus on in our fund is investing in companies that are like powering the technology for the embedded finance with, the idea of being able to have provide a gateway for credit unions to participate in those embedded financing opportunities. So I mentioned the car buying program from Walmart. One of our companies has the technology that's powering that. And we want to be able to, how can we harness the power of the industry as a whole to provide financing for vehicles purchased by Walmart customers through that platform? And is there an opportunity there? And that's where I kind of look at it as sometimes this technology can create some really unique and powerful positive opportunities for credit unions and banks that really are willing to kind of think differently, think outside the box, enter into some of these unique partnerships. And when I look at the kind of the banks and credit unions that are thriving throughout all of this change, not surprisingly, they were the credit unions back in 2016 and 17 when we launched our fund that were really kind of on the leading edge of partnering with fintechs when that was not a thing that people did. And now they're light years ahead of where many of the other credit unions sit today that have kind of sat on the sidelines or really kind of dismissed how much change is taking place.
Have you seen a change in just how many more conversations you're having with credit unions, community banks? Yeah, I kind of teed that one up on the T-ball for you, but
Yeah, yeah. I mean, there's some survey data that was done, and I've been in this now for 8 years. I mean, I can remember in 2017, we talked to a lot of credit unions. They oftentimes will visit our campus, and we talk about fintech and the number of credit union CEOs that were completely dismissive of fintech companies or viewing them as a competitive threat. I mean, I had a CEO literally fall asleep during the middle of my presentation because he was so disinterested and bored. Kind of fast forward to 2019, we saw kind of credit union interest in partnerships where they kind of viewed it as somewhat important or important. It was still below 50%. Fast forward to today, that number, it's around 90% of credit union executives view fintech partnerships as important or very important in that survey. So very much, I think, a shift in attitudes around fintech partnerships. But we're getting a lot of questions now from credit unions. They view it as important, but hey, we've never done this before. We don't even know where to start. How do you evaluate these companies? And so spending a lot of time, again, trying to kind of educate and find opportunities for those credit unions to get engaged. So again, it's encouraging. The only concern is it's moving so fast. If you're just kind of getting in now, you're already 5 to 8 years behind the curve. It's not too late. I tell credit unions that. So don't lose hope or think but I think we need to move faster as an industry to embrace all of these changes. And again, I think there's a huge value proposition. When I talk to fintech companies, more and more are shifting kind of even from a B2B to C model. And so, they want to partner with banks and credit unions now more than ever. Even some of those companies that were direct to consumer are now like, hey, can we offer our product through you? We'll white label what we've built. You offer it to your members, and we both, come out ahead on this. And so it's been really interesting just to kind of see, even the fintech market evolve here.
I want to touch back on just kind of the evolution of the fintech market and kind of how, from your seat, you've seen the interactions between community FIs and the fintechs. But before I do, you were talking about a minute ago, just the embedded finance element and how consumers have so many different choices. I really hope, I apologize in advance, I might miscredit this. I swear it was a LinkedIn post the other day from, I want to say either Ron Shevlin or Sam Kilmer or one of the Cornerstone folks. And the reason I'm pretty sure it was Ron Shevlin is because I remember it being a very in your face statement, which is totally wrong. And it was something to the effect of if you think you're still trying to cling on to, PFI and being the primary financial institution, you're an idiot. And it was that is dead and gone. Just, you gotta accept it, move on. There's no such thing as you're going to control every single element of finance for this, person, and you're going to be their one and only home. You got to let that go, and you got to focus on what you're really good at, and then find ways to bring what you're really good at into the other areas that consumers are interacting with finance. And that kind of calls back to, being a part of embedded finance, right? Or just open banking as a whole. So how have you seen kind of that shift happen, and any mindset shifts you've seen in, the companies that you work with or in your talks with the credit unions and community banks?
Yeah, I think it really depends. I mean, I think we certainly have seen, some credit unions take that approach of hey, we're going to be really good and focus in on these 2 or 3 areas and have these be, kind of drivers of growth. And we're going to be the best at what we do in that space. I even talk to smaller banks and credit unions because I will talk to a CEO running a $200 million credit union, for example. And she has done some really innovative things, kind of has laser focus on a couple of areas. And she's seeing, growth that's kind of outpacing certainly all of her peers, many of whom are kind of in decline. And so I do think that's really important. Again, I could be wrong, but I thought I remember seeing something that Ron put out maybe a month before that, talking about kind of sort of the fintech partnerships are dead or a dying breed. And I couldn't disagree more with that. I mean, what I see is kind of the interest in these partnerships being stronger than they've ever been. We're actually seeing more and more interest even in credit unions making direct investments into some of these fintech companies, which that's a whole different conversation in terms of credit unions or banks that want to invest in some of these companies. I mean, that requires a very different skill set to evaluate fintech companies. But again, I think just the pandemic probably just accelerated a timeline that we were on before the pandemic hit, and in terms of driving more urgency. And again, I'm excited about what the next 5 years hold, because I do see a lot of opportunity here.
That totally brings me right back to what I wanted to come back to, which is, from your seat, like, what have you seen in the interactions between, credit unions and fintechs? Because, you mentioned something to me before we started recording, just kind of how your brain thinks, and you notice, there is a difference. And I've even seen some of this, and I'll talk about some specific examples here in a second, but you look at how a CFO at a community financial institution runs their balance sheet versus how a fintech does, right? And it's very different. The community financial institution is really focused on, long-term viability, stability. We don't need to be, the next SVB type of thing. And fintechs are over here like, we're burning cash like it's going out of style, or like that is our goal. And that is a terrifying disconnect. If you get the financials from a fintech and you're like, yeah, so you lost $100,000 last month, and you lost $100,000 the month before that, and you guys are actually negative in revenue right now. Like, I can't do business with you. Like, you're not going to be around in 2 years. And then they're the next unicorn, right? So what is kind of your, from your seat, like, what have you seen in terms of just kind of how community financial institutions look at and evaluate, even just on the financial and evaluation side, the fintechs?
Yeah, I think for somebody that hasn't been in this space, and they look at evaluation of a fintech company that has, never had a month of profit in its existence, is projected to, be cash flow negative for the next 4 years, and they're valued at $500 million. It's like, how does that math work? So that's why, some of the traditional valuation methods of maybe how they've come across, like, okay, we're going to value a mature business. They're just apples and oranges. I think what we've seen, certainly, kind of on the investor side, is there's been a huge belt tightening with fintech companies. And, that's really a reflection of, kind of the heydays of 2020 and 21 are now in the rearview mirror. I think investors are pushing harder than ever for companies to get to a position of profitability and reduce the cash burn. So I think for the CFOs in the audience, that there's probably more alignment now than there might have been 2 years ago.
No more kombucha on tap in the break room.
Yeah. But when you have credit unions and banks evaluating fintech companies, as part of the diligence, a lot of times they will want to see a copy of the financial statements for that partner as part of their diligence. And, in many cases, the fintech resists that because they don't want to disclose maybe the amount of money that they're losing, or, the fact that they're, down to 12 months of runway of cash. And so, what I tell credit unions in part, look to who their investors are, and do they have a stable pool of investors? Even talk to those investors from time to time of, are they going to be there to provide capital for the next round of funding? Because most of these companies are going to, require multiple rounds of funding to get to a point of profitability. And that's normal in in the tech world. But that's not a reason why a credit union or bank shouldn't partner with somebody by itself. The fact that they, are maybe down to, less than 12 months of runway, because that's normal in the cycle. That probably means, hey, they're going out looking to raise another round. And if they have a good, dedicated base of investors, they're going to be able to raise that capital, and they're going to be around, in month 13 and beyond. So that's, an area where, again, we try to help both sides kind of communicate and understand from the lens of the fintech company why that information is important and relevant, and why it's, it's okay, again, to, I think in some cases, to be, transparent of, hey, here's the situation. We want to be partners, and, investors that are excited and believe in a company are going to be there to ensure that company gets funding.
I want to come highlight a point that you made, and again, I'll set the ball on the tee for you for this one. But it sounds like you guys actually have a lot of conversations, even with the community financial institutions that are looking to purchase from companies in your portfolio, to say, hey, look, I know that you dragged their financials out of them. You're looking at them and you're terrified, but this is all we do. This is what we eat, sleep, and breathe, is evaluate these companies and decide how much capital we want to deploy to them. We 100% believe in them. We support them. If they need more capital, they have access to us, and we will deploy more capital to see them grow, because we believe in, their product, their mission, their people, et cetera. Have you had those conversations? Have you seen that alleviate the concerns of the financial institutions? Like, what does that look like for you?
Yeah, I think it certainly does. I mean, I think our parent company, TruStage, has built certainly a lot of trust among the financial institutions that we serve. And I've heard it many, many times from banking executives of, oh, I saw that TruStage was an investor, and that, provided them with comfort. Yeah, at least, the ventures team there looked at this company, evaluated, and had enough belief in the company to put money into it. So I think, that certainly helps. For, I look at, our mission or mandate for our fund. I mean, one, obviously we have to have, in one, good financial returns. But the other part of our mandate really is, we're a strategic venture capital fund that wants to invest in companies, again, that we think will help get or bring the banks and credit unions into the future, so that they're strong and competitive and relevant. And so, we'll continue to back companies that we think will help achieve that mission, even if the financial returns might be lower than what a pure financial VC would be willing to accept.
I want to get a little edgy with this part of the conversation. So, I mean, I go out on a limb and say, I think that's actually a really important thing. You look at, for credit unions and community banks to evaluate as they're looking at technology partners, right, is where is their capital from? And I think that I would argue that's actually more important than what does the current financials look like, right? Because you kind of have a couple of different flavors of company, right? Maybe you've got somebody that's totally bootstrapped, hasn't taken large investment, maybe it was self-funded early stage. Then you've got folks who've taken investment. And then you've got folks who, are some of the very large players who are probably publicly traded, right? And each one of those groups is beholden to a different master, right? And if you look at a large publicly traded company, yeah, maybe they look really good on paper. Their financials look solid, and they've been around for a long time. They're a big company in the industry, so therefore they're safe. But at the end of the day, you have to remember who their investors are, and a publicly traded company's investor cares about really just one thing. How much money am I going to make off of this? The impact side of that, probably a little bit less. I'm going to be totally honest. The places I put my money in my stocks, all I care about is how much money am I going to make out of those, right? Then you've got the folks who haven't really taken any capital, and yeah, I'm not gonna lie, that one's hella risky, right? Like they're running on a shoestring, and if you're betting on them, like you're betting on a prayer and a song, and right. you really I hope you believe in something really special. And then that middle is kind of that interesting sweet spot. But even in there, right? You look at a fintech company in our industry who has been invested in by a traditional Silicon Valley VC that understands nothing about our market, cares nothing about our market. And they're much more similar to that publicly traded company where that VC firm cares about one thing and one thing alone. I want to see you grow at 300% year over year for a couple of years so that I can take you public. and then you've got that other kind of special class, right? Which is somebody who has taken money from a very strategic partner who is focused on actually providing value in terms of the impact that they have and is there for kind of the long haul of that company. And I would absolutely argue that that's a very important conversation to have within the four walls of your institution of looking at the types of companies you're doing business with and who is their master.
Yeah, I couldn't agree more. Yeah, that is important to evaluate. And again, that's where, we'll have conversations, because even if you're a credit union and you ask, okay, who are your investors? Like that might not mean a whole lot. Like if you're not in the space, like they're not, but to have a conversation with the investor of like, because you can have a company that has, $30 million of cash on their balance sheet, but they're burning $3 million a month and have no plan for, kind of reversing that, versus another company that has $2 million of cash on the balance sheet. They're nearing break even, and the, kind of the investors and board see the company becoming profitable. So on paper, again, two companies that look very different potentially if you're looking at just kind of cash on the table. And so this is a part of the, the diligence that is very unique versus looking at, kind of a lot of the traditional technology providers that have served the industry.
As I've gotten older in life and especially becoming a parent, I think one of the things that I've taken a lot more seriously than I have in the past in my own personal space is calculated risk, right? I've always been a kind of adrenaline junkie, daredevil. Like I'm the guy who wants to bomb a mountain bike down a hill. I like to race cars, and those things are inherently risky. And I can tell you, I've absolutely slowed down the pace at which I ski when I became a parent, right? I'm like, you know what? Let's be a little bit more responsible with my calculated risk. But at the end of the day, I have a lot of fun skiing, and I have a lot of fun skiing fast down a mountain. So I still like to take that risk, but I'm a lot more calculated with it. And I think that that's a good analogy of, I have to laugh. I feel like I've probably referenced her in almost every one of my last podcasts for whatever reason, because the topic keeps coming up, but she's just such a phenomenal example of that is Tracy Miller, who's been a podcast guest before from Pioneer Credit Union in Idaho. And I was even literally texting with her the other night, and I will save the real depth of the conversation and expletives, but Tracy made the comment. She's like, I'm not freaking scared. She's like, I'm not scared. Like, we have got to be smart to jump in and try new things with new fintechs. And they may look scary on paper, and they may have just come to market, and they may have just taken investment, and they may be burning cash. But that's one of the ways that her credit union has really propelled themselves. And, I say it all the time, like they totally box out of their weight class. And it's because she's been willing to take risks, but she's calculated with it, right? Like she's not being stupid with her credit union or her members' money and putting them at risk.
Right.
But she's like, hey, you know what? Like that's something. And I can get on the ground floor of that. And probably by the time that takes off, I can't afford it. But I can today because I can take a little bit of risk. I can work with them. I could be kind of a first pilot customer for them. I could do a customer testimonial for them. And she's doing things that are just absolutely phenomenally innovative because of that strategy. And so I think there's some really cool opportunity for credit unions and community banks to take calculated risks and to step outside the box that maybe they've traditionally played in 25 years ago and be like Tracy, there's a slogan for you, and really say, hey, you know what? Like I'm not scared. Like I'm going to at least look at it. I'm going to have a very clearly defined use case that I'm trying to solve for. And then I'm going to look for ways to solve that are creative. And I'm going to be open to the idea that that may be a fairly scary looking on paper fintech.
Yeah. I think that's so true. I mean, I think the industry is, historically very risk averse, which again, you want your bank or credit union to not take on unmeasured risk, to your point. But I think the flip side of that is if the credit union or community bank just kind of operates, status quo, there's a high probability that FI will have, 50% of the customers they have today. They will, have shrunk in size or relevance, or they will have been forced to merge out of existence. And, to me, that is a much, much greater risk than taking some calculated risks on some partnerships, innovating, taking bite size or baby steps to, kind of learning into some of these things. And I think accepting that, again, there will be some failures along the way. It's inevitable. Like, we're all going through change. Nobody has sort of the roadmap that is tried and tested of navigating through everything. And I think the boards of credit unions and banks, need to provide some latitude and flexibility. I think, the boards, should be pressing to ensure that their credit union or bank is taking, measured steps to navigate through this. And, it's interesting. Like, I spend a lot of time with the NCOA, for example, and many know Rodney Hood, who recently stepped off the board. Really kind of viewed as like, he would just say, Brian, I really support, credit unions partnering with fintechs, because he kind of believed that they were really necessary. He's like, I want to have an industry to regulate in 10 years. And, if credit unions aren't adapting and innovating, he's like, I'm not going to have an industry. We're not going to have a credit union industry. So when you have a regulator kind of like out there, like, viewing the lack of innovation as one of the greatest risks to the industry and ultimately to the solvency of many of these financial institutions. I mean, it really is kind of telling just how big this kind of potential threat is to the market.
Rodney with the mic drop, man.
Yeah.
No, I'm glad you made that comment. Actually, again, some dangerous territory here, but let's talk about boards, because they're super interesting and they play a very interesting role in this as well. I think we've probably all experienced, super innovative people at the credit union trying to do new things, and it gets killed at the board, right? Yeah. And you look at credit union boards, a lot of them, we've been around as long as technology has. So our original genesis of being on the board of the credit union is when we didn't have to do technology or compete on technology or be a part of this landscape. And I think what's interesting is you see, again, kind of, different flavors of that. I'm really proud to say that I get to sit on the board of a credit union, and the CEO of the credit union asked me personally to sit on the board for that exact reason. He's like, hey, look, I want technologists on the board. I want people who are in tech that are willing to stand up with me. And when I say my team has done a bunch of research and we want to do this, and it's a little edgy, I want somebody that's like, yeah, no, you know what? I believe in furthering our mission, and we have to do that through being, a little bit risky and taking some chances and being okay with a few failures. Again, calculated risks, being thoughtful, but really looking at how can we maintain relevancy of the credit union. But at the same time, right, like, the board can absolutely be the reason why, some innovation gets squashed. And I think I probably speak for a lot of smaller stage companies who have gotten down to the final two in an evaluation for a credit union or community bank, only to get the call to say, we went with the big provider because our board just didn't feel comfortable taking a risk on you.
Yeah. I hear that, time and time again. And again, I think, innovation needs to be something that is embraced and pushed for from the board and C-suite of a bank or credit union. I mean, And if it's not being driven from the highest levels of the organization, it's never going to get prioritized, and there'll be no support for that type of innovation. I had a board member, I won't mention the credit union. I just had finished giving a presentation at a large national conference. And one of the topics was, how are credit unions going to attract, younger generation? You look at the average age of a credit union member, continues to creep up. I think their average age is now over 50 years of age. And, kind of talked about how, technology can be a new way to attract the next generation of credit union members. And the board member came up to me. He's like, I hear you, kind of pounding the drum of, needing to bring in younger people. And he's like, why should we go after and serve millennials? Like, I don't think millennials are a good credit risk. And I don't think our credit union should, spend any time or energy focusing in on that market. I'm like, okay, now I understand. As somebody that had previously been in the industry, but was retired, probably 10, 15 years before. And so it's just like that. Then that made me realize what a lot of the executives are kind of going up against. Of how do you, if you're fighting your own board on what we need to do, it creates a real challenge. But it's great, Josh, you're on a board. I'm seeing more of that. I'm seeing more and more credit unions getting much younger board members. And so again, I'm encouraged by the directionally kind of where the industry's headed.
Yeah. I know you didn't mean this, so I'm not picking on you, but I also want to say, like, it's not an age thing either, right? Like, it's not that I'm going to be more innovative just because I'm maybe younger than some of my peers on the board. It is a culture thing, right? I was just on a flight coming back from GAC, and I was sitting next to a board member of a large credit union on the flight, and we got to talking, and she was my senior. We'll just leave it at that. Brilliant, absolutely brilliant person. Super, super innovative thought process, like the types of questions she was asking me and we were talking about. I was like, that is the kind of board member you want. Like, that is a woman that is going to help propel her credit union to take calculated risks and do cool things. But it is, to your point, it's like when you get folks that maybe have just kind of stagnated in the industry and are on the board, that I think is the detriment, right?
Yeah, probably the point I was trying to make is I think diversity on the board is so critical, and getting people with different thoughts, different experiences that are on that board versus it being an echo chamber of maybe board members that are kind of living in the past or don't have any experience in kind of seeing where this industry is going and all the change taking place. I think getting these different viewpoints is really critical. I think we're seeing much more awareness around getting a diverse board at credit unions.
Yeah, I love that statement. We've had a few guests on recently talking about just the huge DEI movement, specifically in the credit union and community bank space over the last few years, and I love what that actually means and what that actually looks like. Because what it means is that we're being a lot more thoughtful and intentional about bringing people that think uniquely different from each other and bring challenging and opposing opinions, but facilitated around a culture of respect and openness. And that is how we're going to grow as an industry. If you put a bunch of people on the board that all look like you, talk like you, act like you, think like you, make decisions like you, then you're going to do the same thing over and over again. And I will put my personal stake in the ground. You will be irrelevant. You need some people
it's so
that
important.
think different.
Yeah, it's so important. In 2021, just really, kind of on this point, we actually launched a second fund called the Discovery Fund. And all of the founders in the Discovery Fund are led by founders who historically have been very underrepresented in venture capital. So women founders of color, LGBTQ founders. And, when we kind of looked across our portfolio, kind of a lot of those founders all, kind of looked the same, came from many of the same backgrounds. And we have now 17 companies in our discovery fund. Many of these companies, are really focused on serving the consumers that often are overlooked or underserved. And now our mission is, let's bring those fintech companies together with credit unions that want to, again, like, think outside the box, or pilot or partner with an early stage company that might be able to enable that credit union or bank to reach a totally new demographic. And so there's just, again, so many opportunities that exist today for banks and credit unions to really leverage these partnerships to grow in very unique, in impactful ways.
That's super exciting. I love hearing stuff like that, because this is a really, really exciting industry to be a part of. And there are so many people with some really great ideas out there, and giving people the opportunity to create companies, to leadership decisions at the financial institutions buying from these companies. Like, this is what's going to further this industry. And, as you and I kind of started with, and anybody who's listened to even half of a podcast I've ever done, hopefully knows this about me. Like, this is an industry we care about, right? Because we see the impacts that it has. We see the impacts that it has on actual real people and their lives. And money is such a huge part of our lives. Having someone that's in financial services that's kind of in your corner is a total difference maker. I mean, that makes the difference in people's lives. That's crazy to think, but it's true.
That probably is the thing that motivates me the most when I get out of bed in the morning. Coming from a very modest background, family of modest means, working with community financial institutions, and our fintechs often are very mission aligned with credit unions. We like to invest in companies that have a culture and mission that aligns with our purpose. And I just see the opportunity to help so many consumers that are struggling to make ends meet, struggling to try to build credit, struggling to kind of get out of the cycle of payday lenders, and stripping out the technology and getting to the underlying mission of helping people achieve financial security is really something that I'm proud to hopefully help move the needle on.
Yeah, I love that. I'd be remiss if I let you go, though, without talking about just the state of capital deployment, right? I'm sure everybody listening has heard some of the news stories and seen capital's drying up. People aren't getting investment. And so what have you seen? And specifically, from the community FI space, the companies that serve them, and funding available to them. And what does that mean for that industry? And what does that mean for a credit union that's looking at partnering with different fintechs?
Yeah, I would say, the last, 2 years, so 2022 and 2023, I mean, you look at the numbers, the amount of funding going into these companies is down significantly from the 2 years prior to that. But, I think those were two outlier years that probably will never be replicated. And it was really driven by, I think, kind of the pandemic frenzy, where all tech companies, could raise unlimited amounts of money at insane valuations. So we probably have normalized somewhat, I think. And I'm seeing that now. What we're seeing a lot more companies going out and looking to raise capital. I think more rounds getting funded and closed. So I think the industry on the investor side, we see stabilization in the market that we didn't see the last 2 years. And so I think a lot of the investors I'm talking to feel the same way, feel a little bit more confident about deploying funds. I think valuations have come down to a point where, again, there's probably still some downward adjustment on some companies, but when the valuations normalize, then investors will be willing to again start deploying more capital. So I feel like kind of the worst is behind us. And again, I think going back to the beginning of the conversation around new cases around AI, I think that's going to drive a fresh round of capital into, a number of companies.
Yeah. That's a good point. And that kind of goes back to what we were talking about earlier, right? Of if you look at fintechs that are successfully raising funds right now, it's a pretty good sign that they're onto something and they're doing something right. If folks like you guys, see the value in investing in an organization like that, or continuing to invest in an organization like that.
Yeah, completely agree with that. And there's also still a lot of capital that hasn't been deployed. So a lot of the different, venture funds that maybe took a break from heavy investing, still have capital that's available to deploy, and good solid companies are going to continue to get funded. And so, if I'm a bank or credit union leader reading the headlines around, the funding for fintech companies drying up, one, I wouldn't agree with that statement. And two, again, I think, it certainly heightens the importance of the diligence on that front. But I think the industry is going to do fare quite well over the next several years.
Yeah. Yeah. I think that's a good point to highlight is, like anything else, right? The news likes to get us with clickbait, and the sexy headline to click on is, funding has dried up for fintechs and they're all going to die off. But I think to your point, right? Like if you come in with a pitch deck that just says we do AI, we'll give you, 400 million at a 50x valuation. Like those days are probably over, and they probably should be, because you're, smoking something funny if you're thinking that that's going to be a viable company at that valuation with that kind of capital deployment at that stage. Like, yeah, maybe that's dead, and that's probably a good thing. But
it is a good thing. Yeah, we have discipline back in these businesses, which definitely is a positive for everyone.
Well, Brian, seriously, I've really enjoyed this conversation with you. I really hope this was valuable for some folks to hear a little bit of, how the sausage is made of, just looking at the role of capital deployment in supporting the credit union mission through fintechs. So this has just been a really, really cool conversation. I appreciate the opportunity to chat with you.
Yeah, thanks a lot, Josh. I've had a lot of fun spending time here today, chatting on something that I'm very passionate about. And so I really appreciate it.
Yeah. Well, before I let you go, two final questions for you, sir. So first of which, just where do you go to get information to stay up to date on what's happening in the industry? I think this is especially an interesting question for you. So yeah, where are you getting your information? How are you finding some of these cool new fintechs? What do you stay up at night reading?
Yeah, so it's really, I get the benefit again of having a lot of exposure to credit union leaders and also kind of the fintechs and investors. So I hear a lot of my information I'm getting just kind of firsthand. I spend a lot of time on Zoom calls or at conferences in the hallways. I find that to be very insightful. The other benefit I have is being part of a large organization. We have a phenomenal business intelligence team that puts together a daily internal newsletter that's covering kind of all topics fintech that really kind of are relevant to banks and credit unions. And so a shout out to Steve Husick and that team of really kind of scouring all of these different resources. Yeah, I mean, CB Insights and PitchBook have valuable tools we use as well to look at market trends. So, sometimes it can be information overload because there is so much out there. And so having, some of these resources is just very invaluable. And Digital Banking Podcast, another great source of information for the audience members.
Thank you. It's funny you make that comment about just the volume at which you probably see a lot of these fintechs popping up. I don't know how relevant this data is now, but it was kind of in the height of the pandemic. A friend of mine in the industry used to make a joke like, there's a fintech born every minute. And then he was like, I'm actually curious, like how often is a fintech born? And so he did a little bit of research and he was like, okay, I was wrong. It's only one every, 5 days or something like that. Whatever the number was, it was like mind boggling. You were like, oh, his joke actually wasn't that far off. Like it's ridiculous the number of fintechs that are born. So yeah, there's a lot to keep up on. That's for sure.
Yeah,
Okay. Okay.
live
Go
and
ahead,
breathe
sorry.
in this, and I'm always amazed at when I get through the end of the week and I look at all the companies that have reached in to try to connect with us, like how many are like, okay, I've never heard of this company before. I've been in this space 8 years, and I recognize 50% of the companies that have reached in. And so if I'm a credit union leader, I don't know how you try to keep up with all of these companies and to your day job. So that's where we can help, kind of just do some of the kind of sorting and sifting for those banks and credit unions.
Well, great segue to my last question then. So if people want to connect with you or if they want to learn more about your guys' fund, like how can they do that?
Yeah, a couple of ways. I mean, obviously, feel free to reach out through LinkedIn. We have a platform we call the FinTech Forum. We have almost 3,000 credit union and bank leaders and fintechs, again, to create basically an online community which provides a lot of information and content on fintech collaboration. And that can be accessed through TruStage Ventures.com, and you can sign up for that. Otherwise, just my contact information will be out there as well. So I love to hear from people in the industry and hear what's top of mind for them, because that really guides where we spend our time and resources.
That's awesome. Well, again, Brian, thank you so much for being a guest on the Digital Banking Podcast.
Great. Thank you so much, Josh.
Thank you for listening to the Digital Banking Podcast powered by Typho. Find more episodes on digitalbankingpodcast.com or subscribe on Apple Podcasts or wherever you get your favorite podcasts.